My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, just trying to make you some money. My job is not just to entertain you, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. And then there were none. I am talking about the endless slaughter of the great growth stocks of this era, something that dragged down the averages, Dow slipping 97 points, S&P declining 0.53%. But the NASDAQ, yes, where the great growth stocks live, tumbled 1.56%. This is an unkind market. Today, it chose to once again lay to waste the stocks that sell at a very high price to sales multiples. And we got to go over the genesis of this move because it's very stark and it's causing many people huge losses. And for many people who want to own these supercharged growth stocks at super high prices, this could be your denouement. I don't want that to happen. First, let me back up and use this twilight of the high-flying idols moment to explain the way big money thinks versus the way that small money thinks, because they are two very different animals. While this market has strong sectors like oil, which we'll be going over at length closely at tomorrow's 12:30 Investing Club meeting, or healthcare or transports, it also has another cohort, and it's the now hated, formerly loved, supercharged go-go stocks that trade on the price to sales multiples because the earnings are either non-existent or negligible. Oh, that last cohort is under siege right now like I haven't seen it in years. You might wonder, with so many stocks that are cheap after the blasting this market has endured, who would still hold out and stay with these beaten down, unprofitable names? The answer, either money managers that are under no pressure to perform anytime soon so they can afford to make long-term bets like Cathie Wood and her ARK funds, or uninformed individual investors who got into these stocks during the pandemic, initially made big money, and are now hanging on by their fingernails. I don't think they'll be able to hold on much longer because they don't know what they own. And eventually, when you don't know what you own, sadly, you get blown out. And your ultimate goal must always be the same. Stay in the game. We can't all be Cathie Wood with endless money to lose at will and not have to pay for it. Ironically, the proximate cause of today's growth stock beatdown was a pair of companies that we spoke to last night on Mad Money, Okta and Snowflake. After they reported numbers that were widely panned, even as in another time when inflation wasn't raging, they would have been respected, perhaps even loved. Now, these two stocks have been plummeting, in fairness, ever since they peaked in November. Right here, look at that. You can see. They peaked in November, along with the entire high-growth universe. I can put up any number of stocks that are going to look just like this. That alone should tell you something, right? As Okta's a cybersecurity play and Snowflake is a novel data analytics play with a tremendous growth rate. But you can't escape from your broad rubric of a sector. And the turbocharged growth stocks all became a lot less attractive when the Fed started talking about raising interest rates right here. That was it, right there. Many of these companies have done nothing wrong. They are, frankly, just collateral damage from the Fed's newfound fight against inflation. Seasoned investors immediately dump the growth stocks because if you've got experience managing money, you know that growth stocks always get killed when inflation's roaring, as it erodes the value of their future earnings. You may think these companies are the greatest things in sliced bread, but the pros know not to pay as much for unprofitable sliced bread when there's an inflation spiral. So you can see that's them fleeing, okay? That's just them getting out of these stocks after a real good run. Now, there's another group of investors, though, who aren't that knowledgeable about what happens at this point in the cycle. Yes, that's the business cycle, either because they're too young or maybe because they don't care. These are people who love the momentum of the stocks. They love this, okay? Even if they didn't really understand what the underlying companies actually did, they just had faith that their stocks will bounce back at some point in the future. Others have done more homework and like the momentum of the business. They think it can transcend the current moment. They don't see what inflation has to do with any of this. And there's still one other group we haven't mentioned lately, the people who love to buy hot stocks on dips because, well, buying hot stocks on dips was a fabulous way to make money for ages in the great bull market. Now, over the last few months, these owners, I hesitate to call them investors, they're not, hung on because the actual fundamentals of the great growth companies had actually been unchanged. When those companies reported, they typically beat the sales estimates, delivering some humongous revenue growth and ever smaller earnings losses. And that happened right through this period. You don't want to look at those reports. You'll never spot this if you just look at the reports. You would never know that this was going to occur. Each time the analyst acolytes would dutifully raise their estimates and their price targets, even when it was clear because of inflation that the old price target boosts were producing ever smaller gains in stocks, and in some cases, no gains at all. Now, along the way, the dip buyers who traded out when stocks jumped started losing big money. They were maybe doing it in call options. Maybe they were buying stocks with borrowed money margin. Their ranks have grown ever thinner as the losses mounted. And they came to realize that they weren't buying a dip. They were buying the veritable Grand Canyon of drops. They were buying a fall from the north face of Everest. The other two groups, those who love the cadence of beat and raise, beat and raise, beat and raise, and those who love the momentum of either the stocks or the underlying business, they've been hanging on for dear life. As inflation continued to erode the faith in growth stocks, especially unprofitable growth stocks with high price to sales multiples, because there are no earnings. Then yesterday came. Yesterday was the Waterloo, my friends. True Waterloo watershed. First, Jay Powell, the head of the Federal Reserve, recognized that inflation is accelerating. Said he would start trying to contain it by raising interest rates, maybe at 25 basis point. Hey, maybe more. Then Okta and Snowflake reported after the close. Okta, which does identity and access management, in particular a kind of really good cybersecurity, reported better than expected revenues and a smaller than expected loss for the fourth quarter. Bingo, right? No issues. Then the company also issued forward guidance that included, again, better than expected sales, but this time much bigger than expected losses. Now, that might have been overlooked in the pre-inflation era, but it was unforgivable in this new world, and the stock cascaded immediately. And believe me, it is not done cascading. Snowflake reported amazing sales, smaller losses. So far, so good. But then forecasted a slowdown in its growth rate. Unacceptable. Slowdown in the growth rate. Ouch. That's a nightmare for those who live by the rules of momentum, especially in an inflationary environment. Now, given that there are so many momentum camp followers and so many ETFs centered on the businesses that are covered by this, right? These two names did literally bring down the proverbial houses of both groups. Both of them got crushed by these two stocks. Next thing you know, you've got the analysts shockingly cutting price targets galore. And there's a tsunami of selling. Even as I think that Snowflake will be able to come out of this just fine because CEO Frank Slootman, I believe, was merely being conservative in his forecast. But why didn't that matter? Well, remember what I said. Many people who own Snowflake only owned it because of the chart. They were willing to pay 100 times sales for it at one point. Many of these people didn't even know what Snowflake did. I mean, maybe they thought it was like a meteorological thing. So what happens now? The momentum is gone. The charts are broken. The dip is a World War I trench, and the thrill is gone. I think that many of these stocks, many of the people who are, I think many of the stocks are done. I didn't want to say that, but I do. And the people who own them, they've lost too much money. A lot of them are doing what I was afraid of back in November. They're going back into CDs, money market funds, trying to hide in cryptocurrencies. At least it was more fun when they were losing money in Dogecoin. Others are licking their wounds and waiting for better times that may now come, may not. So others, like Cathie Wood, simply don't care because they're so dogmatic. Now, you know I believe there's always a bull market somewhere. And we have one now in natural resources, with another one maybe coming in the staples and the healthcares as the feds hit the brake, and maybe they're hitting the brakes too hard. But high-growth tech, I'm always going to have some, but wow, it's tough sledding. The bottom line is that the era of beat and raise and buy no matter what is over, well, let's just say it's done. It's over for the formerly high-flying growth stocks. There's still plenty of other stocks out there. But if you're still betting on these bouncing back, well, let's just say, why don't you pull in your horns? Because I don't think it's going to work. Let's go to Lucy in California. Lucy.
Hi, Jim. How are you?
I am doing fine, Lucy. How about you?
Great. Thank you. I wanted your opinion, please, on Twitter stock. Lately, it's been declining, and I just wanted to know if I should hold my present position or sell while I have some gains.
No, look, it's a legitimate question because the stock is down to 33. By the way, that's about where a few years ago people thought it might get taken over. But the fact is it's still a very high price to earnings multiple stock, and we're not recommending those stocks because they don't do well enough in an era of high inflation. Let's go to Renee in New York. Renee? You're up, Renee.
Booyah.
Booyah, Renee. What's going on?
I love your show. Thank you.
Thank you. Thank you very much.
I have a question.
Uh-huh.
I have some KMI, the old Enron,
Right.
and they have pipelines from Canada and Washington State
Right.
all the way down to Tennessee.
Uh-huh.
Do you think that it's good to buy more?
Oh, no, and it's really, a lot of it's in Texas. Remember, they were not really the old Enron, which really went under, but they're a great pipeline company. It's finally coming back. It yields 5.8. It's got the money to be able to back that. That's the kind of stock I am liking in this market. I know it's unexciting, but it is a good place to be. It's certainly right at this particular moment. Okay, look, I mean, it's hard for me to talk about these stocks because you know I like them so much, but you know, it's a new reality out there for the high-flying growth stocks. The year of beat and raise and buy no matter what, it's over. It's time for you to come to terms with that. You can own some of these stocks. You just can't own all of them. Otherwise, your time in the stock market is going to be up, and I need you to stay in the game. On Mad Money tonight, Verizon laid out a plan to expand its Investors Day earlier. I'm learning more about the company's mission with the CEO, and that's got a nice yield. Then in this market, it's time to take a little more conservative approach, as I just said. So I'll give you a safety stock that works. And here's one that's hard. Block, formerly known as Square. It fell today. It's got great growth. Let's make some sense of it with the company's CFO. Stay with me.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.